Ruth and her husband Walter never thought of themselves as wealthy. Walter spent 41 years as a commercial plumber in Green Bay, Wisconsin, and Ruth taught 5th grade for 37 years. They lived in the same 3-bedroom ranch they bought in 1987, drove used cars, packed lunches for work, and shoved every spare dollar they could into their 401k plans. They never earned 6 figures individually. They simply saved steadily through every market dip and every bonus year for 4 decades. When Walter retired at 67 in 2023, their combined retirement account balances crossed the $1 million mark for the first time, a milestone they barely celebrated. 2 years later, at Walter's 73rd birthday, a letter arrived from the IRS reminding him of his required minimum distribution obligation. When Walter sat down with his accountant to calculate the full tax picture for the next 10 years, he realized something that made him genuinely angry. Because he and Ruth had been so disciplined, because they had let the accounts grow untouched for decades, their future RMDs were going to push them into higher tax brackets than they had ever occupied while working. The cruel irony of the American 401k system is that it rewards decades of disciplined saving with a steadily rising tax bill in the final chapters of life, and most retirees who cross into millionaire territory only discover this when it is already difficult to fix. If you have accumulated over $1 million in a traditional 401k or IRA, and you are within 10 years of RMD's beginning, what you do between now and 2027 will determine whether you pay hundreds of thousands of dollars in avoidable tax or whether you keep that money working for you and your family. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. With that understood, let us walk through exactly how to reduce future RMDs legally before the window closes. Start with the underlying math, because it is worth seeing starkly. Suppose you have $1 million in a traditional 401k or rollover IRA today. You are 65, you are retired, and RMDs begin at 73 under Secure 2.0. If your account grows at a moderate 6% annual return for the next 8 years, it will reach approximately $1.5 million by the time your first RMD is due. Your first RMD at 73 is calculated by dividing that balance by the life expectancy factor of 26.5. That produces a forced distribution of roughly $56,600 in the first year alone. Every year after that, the factor drops and the percentage rises. By age 80, if the account continues to grow at a modest rate, even with withdrawals, you will be forced to withdraw somewhere between $70,000 and $80,000 a year. By age 90, if you are still alive and the account still has a balance, you will be forced to take over 10% of whatever remains annually. Every dollar is taxed as ordinary income at your marginal federal rate, plus state tax, plus any second-order effects on Social Security taxability and RMD surcharges. For a retired couple with $1.5 million in tax-deferred accounts, plus 2 Social Security checks, plus perhaps a small pension, the combined taxable income often lands between $90,000 and $130,000 a year, squarely in the 22% federal bracket, and frequently crossing the first or second IRMA tier. Over a 25-year retirement, the total federal and state tax paid on distributions alone can easily exceed $300,000. This is the quiet cost of disciplined lifetime saving that was never strategically converted, balanced, or managed. The good news is that you have tools. The best of them is the Roth conversion. And the strategic window for most 401k millionaires is the gap between retirement, the start of RMDs, usually between ages 62 and 73. During this window, you typically have lower earned income, you control your own withdrawal timing, and you can convert traditional IRA dollars into Roth IRA dollars at whatever pace produces the lowest lifetime tax. Converted dollars pay tax now at your current rate and then grow tax-free forever. No RMDs on Roth IRAs during the original owner's lifetime. No tax on qualified withdrawals, no tax on the growth, no increase in Social Security taxability, no RMAA surcharge impact once the conversion year is behind you. Converted dollars are fundamentally reclassified as post-tax retirement money. They behave very differently for the rest of your life. The key to doing this well is bracket management. The current federal tax brackets, set to sunset at the end of 2025 but extended in various forms through recent legislation, remain favorable through 2027. The 12% bracket currently extends to roughly $96,000 of taxable income for married filing jointly, and the 22% bracket extends to roughly $206,000. The difference between filling up the 12% bracket and crossing into the 24 or 32% bracket later is enormous over time. If you can convert enough dollars each year to fully use the 12 or 22% brackets, but not a dollar more, you are effectively prepaying tax at the lowest available rate and eliminating the forced distributions that would otherwise spill into higher brackets later. Beatrice, a retired accountant from Tucson, Arizona, ran a 6-year Roth conversion ladder from ages 64 to 70. She and her husband had combined traditional balances of $1.3 million. Each year, she converted approximately $60,000 from their traditional IRAs to Roth IRAs, calculated precisely to fill the 12% bracket without crossing into 22%. Over 6 years, she converted $360,000, paying an effective tax rate of about 10% across the converted amounts after accounting for their standard deduction. By the time her husband turned 73, their remaining traditional balance had been reduced, their future RMDs had been cut roughly in half, and they had $360,000 of Roth assets growing tax-free for their remaining lives. Their projected lifetime tax savings, compared to doing nothing and letting the RMDs unfold at their natural pace, is estimated at over $140,000. Let me walk through the mechanics of how to do this carefully. First, you need to understand that a Roth conversion is irreversible. The rule that once allowed recharacterization or undoing a conversion was eliminated by the Tax Cuts and Jobs Act. Once you convert, the money is permanently converted and the tax is due for that year. Do not convert more than you can comfortably pay tax on from outside the IRA, because paying the tax from IRA proceeds defeats the purpose and can trigger a premature distribution penalty if you are under 59 and a half. Second, time the conversion carefully within the calendar year. Many advisors recommend doing conversions in the final quarter, November and early December, once you have clear visibility into your full year's income. That way you can calculate the exact conversion amount that fills your target bracket without going over. Some advisors split conversions across multiple months to dollar cost average into Roth during potentially volatile markets, which can be advantageous if market prices drop between conversions. Third, coordinate with your Medicare RMA planning. Remember that Medicare looks back 2 years. Your 2026 RMA is based on your 2024 tax return. Your 2027 RMA will be based on your 2025 return. Your 2028 RMA will be based on your 2026 return. A Roth conversion this year can therefore trigger an RMOA surcharge 2 years from now, even though the conversion itself is a one-time event. Budget for the RMA effect as part of the conversion cost, and consider sequencing conversions to minimize the number of years you cross into higher IRMA tiers. Fourth, use Form 1040-ES to make estimated payments on the Roth conversion amount, or adjust your W-4P pension withholding to cover the additional tax. If you underpay during the year, you can face an underpayment penalty calculated on Form 2210. The safe harbor rules allow you to avoid the penalty. If you pay at least the lesser of 90% of the current year's tax, or 110% of the prior year's tax, through withholding and estimated payments. Beyond Roth conversions, there are 4 other RMD reduction moves worth considering before 2027. Move 1. If you're still working past age 73 and participating in an employer 401k plan, you may be able to delay RMDs from that specific plan until you actually retire, under the still working exception. This does not apply to IRAs. It only applies to the 401k of your current employer. If you have rollover IRAs from prior employers, those still require RMDs at 73 regardless of whether you are currently working. Some retirees who plan to work past 73 deliberately roll their outside IRAs back into their current employer's 401k, if the plan allows it, to defer RMDs on the entire balance. This is sometimes called a reverse rollover, and it can be useful for higher income retirees who are still earning significantly. Move 2. Consider the Qualified Longevity Annuity Contract, or QLAC. A QLAC is a specific type of deferred annuity that allows you to remove up to $210,000 from your traditional IRA for 2026 and use it to purchase an annuity that does not begin paying until as late as age 85. The amount inside the QLAC is excluded from your RMD calculation. For a retiree with a $1.5 million IRA, shifting the maximum allowable amount to a QLAC reduces the RMD base and defers tax on those dollars until the annuity payments begin. QLACs have their own trade-offs, including surrender value limitations and counterparty risk tied to the issuing insurance company, so they should be evaluated carefully. But for the right retiree, a QLAC is a legitimate RMD reduction tool worth knowing about. Move 3. Qualified charitable distributions, as I covered in detail, in another video, allow you to send up to $108,000 a year directly from your IRA to a qualified charity once you reach 70 and a half. Every dollar counts toward your RMD requirement, but is excluded from taxable income entirely. For retirees who are already charitably inclined, running all charitable giving through QCDs is one of the cleanest, simplest RMD reduction tools available. Move 4. If you have a surviving spouse or planned bequests to adult children, think carefully about the Secure Act 10-year rule for inherited IRAs. Under the current rules, most non-spouse beneficiaries must fully drain an inherited traditional IRA within 10 years of the original owner's death. If your children are high earners in their 40s and 50s, a large traditional IRA inherited late in their working years can push them into the highest federal brackets, dramatically increasing the total tax paid on your lifetime savings. Roth conversions during your lifetime, even at your own modest bracket, often produce far better overall family outcomes than letting a traditional IRA pass to high-earning heirs. Think of it as a generational tax arbitrage. Nancy, a retired dental hygienist from Savannah, Georgia, discovered this late but acted on it quickly. She had a $900,000 traditional IRA, 2 adult sons, both earning over $200,000 a year in their professional careers. Her accountant calculated that if she simply let the account grow and passed it on at her death, her sons would each inherit roughly $500,000 after some depletion, and they would have to withdraw that balance within 10 years at their top marginal federal bracket, which could push their combined federal and state rate close to 40%. The family tax bill on the inheritance would approach $200,000. Nancy chose to aggressively convert $60,000 to $70,000 per year for the remaining years of her life to Roth, paying tax at her own 12% and 22% brackets. When she passes, her sons will inherit the Roth balance tax-free, subject only to the 10-year drawdown timing, and the family's combined lifetime tax will be dramatically lower. 3 specific traps to avoid when building an RMD reduction plan. First trap: do not overconvert in any single year, because a conversion permanently raises your AGI for that year and cannot be undone. Run the numbers carefully, including IRMA, Social Security taxability, and state tax before executing. Many advisors now run what they call a stress test conversion projection each year in October using tax software. Second trap: remember the 5-year rule on Roth conversions. Each conversion starts its own 5-year clock. If you are under 59 and a half and withdraw a converted principal before the 5-year mark, you may owe a 10% early withdrawal penalty, even though you already paid tax on the conversion. For retirees over 59 and a half, this rule is less restrictive but still worth tracking, because earnings on converted funds are subject to the account's 5-year rule for tax-free treatment. Third trap: if you miss an RMD after it becomes required, the penalty under Secure 2.0 was reduced from 50% to 25% of the missed amount, or 10% if corrected promptly through Form 5329. That is still a significant penalty, so the year you turn 73, calendar the first RMD deadline carefully. For most retirees, the first RMD can be delayed until April 1st of the year following the year you turn 73. But doing so means taking 2 RMDs in 1 calendar year, which can have its own tax consequences. Usually taking the first RMD on schedule by December 31st of the year you turn 73 produces the smoothest tax outcome. Let us do the consolidated math on the entire opportunity. Suppose you are 65 today with $1 million in a traditional 401k. You run a Roth conversion ladder for 8 years, converting approximately $70,000 a year, filling the 22% bracket carefully. Over that 8-year window, you convert roughly $560,000 and pay approximately $120,000 in federal and state tax, funded from a taxable brokerage account. By the time RMDs begin at 73, your traditional balance has shrunk to roughly $800,000 due to conversions offset by continued growth. Your first RMD is now $30,000 instead of $57,000. Your Social Security is taxed at a lower effective rate because your AGI is lower. You stay under the first IRMA threshold instead of crossing the second. Over the next 25 years, your cumulative federal and state tax is reduced by somewhere between $120,000 and $200,000 net of the conversion tax you prepaid. Your Roth IRA grows to nearly $900,000 tax-free for your remaining lifetime and for your heirs. The total lifetime and a generational tax savings, including reduced IRMA A, reduced Social Security taxation, and preserved generational wealth, commonly exceeds $300,000 for $1 million starting balance. None of this requires exotic products or aggressive tax moves. It requires planning, bracket management, and execution during a specific window that for most retirees is currently open. That window closes as you age into RMDs, as federal brackets potentially rise in future legislation, and as your accounts continue to compound. If you are a 401k millionaire with 8 to 15 years before RMDs begin, this is the decade that matters most. Build a multi-year conversion plan with a qualified tax professional, coordinate with IRMA planning, fund the tax from a taxable account, and track the results annually. Small moves in the right years produce enormous differences by age 85. One final consideration that many 401k millionaires overlook: the optimal RMD reduction strategy is almost never a single tactic. It is a coordinated sequence of Roth conversions, QCDs, careful withholding management, RMA-aware income planning, and occasional use of QLACs or employer plan rollovers. Each individual tactic is useful on its own, but the combined effect of running all of them in parallel produces the largest lifetime savings. This is why a dedicated annual planning session, ideally in October or November with current year numbers in hand, is worth its weight in gold. You are not trying to find a silver bullet. You are trying to stack small, legal, repeatable advantages year after year across an extended retirement. If you found this helpful, the best thing you can do is share it with one specific person in your life who crossed the 7-figure threshold in their retirement accounts. Most of them do not know these strategies exist, and most advisors focus on investment management rather than tax management. A conversation about this one topic can preserve tens or hundreds of thousands of dollars for a single household. Subscribe to the channel for next week's deep dive on net unrealized appreciation, or NUA, which is a separate powerful strategy for retirees holding employer stock inside a 401k. Thanks for watching, take care of your future self, and see you in the next one.